Hey listeners, I just had on FP Lee, co-founder of Sanctum. Sanctum is a liquid staking project, which, for those who aren't familiar, basically refers to creating a tokenized version of staked tokens. So in Solana's case, instead of having your SOL locked up, you can use or trade that staked SOL like you would any other token. Now, Sanctum got big in mid-2024, and since then it's launched LSTs for every Solana validator, and it helped provide infrastructure for Binance's Solana LST, which is the second largest behind Jito's SOL. But now it's striking out in an ambitious new direction. Sanctum acquired Ironforge in an all-cash deal and has begun working on transaction landing infrastructure for Solana, which is always a challenge on a network primarily known for its speed and throughput. How is Sanctum thinking about its second act? Let's find out. This episode is brought to you by Katana, a DeFi-first chain built for deep liquidity and high yield. You'll be hearing more from them later in the show. Blockworks Digital Asset Summit, which is crypto's premier institutional event, is back in London October 13th to 15th. It'll have speakers from leading global funds, financial institutions, DeFi protocols, crypto companies, and policymakers. Think BlackRock, Circle, Coinbase, the UK Parliament, Jito and Marinade, all under one roof. Notable names include Joe Lubin from Consensus, Hadley Stern from Marinade, Rebecca Reddick from Jito Labs, a whole bunch of Blockworks folks, and more to come. There's a VIP dinner October 13th, open to speakers and VIP ticket holders only. That will sell out, so act fast. And it's all going down at Old Billingsgate, London. Use the code LIGHT100 for £100 off at checkout. We'll see you there. Nothing said on Lightspeed is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed. Hello and welcome back to another episode of Lightspeed. I'm your host, Jack Kubinek, joined today by FP Lee, the co-founder of Sanctum, appearing on Lightspeed for the second time. First time I've ever interviewed him, so very excited for this conversation. FP, thank you for coming on the pod.
Thank you for having me.
So you came on Lightspeed, 2024 around the beginning, I believe, or mid 2024, and Sanctum was going through the Solana incubator, I believe, and was this buzzy new sort of startup doing something different and exciting with liquid staking. And so there was just kind of like a real intrigue about what Sanctum was. There was obviously like the lead up to TGE as well. That's all already happened. The cloud token is out, and Sanctum's been around for a little bit of time now, and so it's been interesting to kind of watch your journey and how Sanctum's tried to diversify its business and launch new streams of revenue, and they're really like Sanctum genuinely does create revenue. Which has been really interesting to watch. Like, I don't know, at the beginning, it's always an open question for a lot of these teams. So kudos there. But I guess maybe just to start out, for those who are less familiar with Sanctum or whatever, just give us like a quick overview of where things stand today. What is the core Sanctum business?
Right. So we do a lot of things, but I think what the thing that we are most known for is our staking business, and in particular our liquid staking business. And so when we first started, a long time ago, right, liquid staking on Solana was really much in its infancy, and it looked very much like the Ethereum model, right, which was kind of like a winner-take-all kind of model. As you know, on Ethereum, it's basically Lido taking most of the market share, and then there are a couple of competitors. And so, but when I started on Solana 4 years ago doing liquid staking, I realized down the line that because of the nature of how staking works on Solana, it's quite different, and therefore I thought the competitive landscape and how liquid staking should work on Solana is also very different, and that kind of like little technical detail in how staking works then had sort of like multiple downstream implications, right? And then it took us the better part of like 2.5 years to basically build that out. But my core thesis was that number one, that liquid staking tokens will proliferate on Solana, that the marginal cost of creating these liquid staking tokens will be very low, and that we need to build for a future with like infinite liquid staking tokens and a unified liquidity layer between them. And that really was the kind of like genesis story of Sanctum. And so we have this liquid staking business, right? In particular, it's I would call it kind of like a white label liquid staking business, right? Where we work with partners like Jupiter, Drift, right, Bybit, Gate, Crypto.com, etc., and of course many other LSTs as well, to really launch their own liquid staking token for a variety of reasons. But the main reason I would say is that if you can get someone to hold your liquid staking token, then you can make revenues, right? And so that is like a model that we have, and it's all powered by Sanctum's kind of unified liquidity layer underneath the hood to make sure that these liquid staking tokens remain liquid. And so like that's the core business. Yeah.
And speaking to those core differences between Solana and Ethereum, I would think one of the main ones is just the fact that Solana's unbonding period is much shorter, and so if you want to unstake your Solana, it only takes the epoch to the end of the epoch, whereas for Ethereum it's a week or whatever it is, and so you can't as reliably get access to that unstaked SOL, or you can't as reliably get access to that unstaked ETH, whereas you can for SOL. And so you could do something like a infinite LST or a shared liquidity layer. Is that right?
That's one of the reasons, but I think the primary reason is that just the liquid staking contract. So in Solana, there is this thing called a stake account, right? Which is that when you need to stake, you get the stake account. And the way the liquid staking program was written is that when you do when you do an unstake, you actually it isn't like a queue and you have to wait to get it. You get your collateral, I guess, which is your stake account right away. And sort of that enforces some sort of like semi-fungibility. They're not obviously fully fungible because they're all stake accounts have different validators and this and that, but they all have kind of like a inherent sort of value to them, and they are kind of like semi-fungible with one another, which means that you can build this sort of unified liquidity layer, which means that you can have now this explosion of new LSTs, and all building upon that unified liquidity. So I think that's the main difference. Yeah.
Okay, interesting. And then as far as the end state of where this takes things, we've seen Ethereum has more history behind it, I suppose. And what ended up happening with Ethereum was that you have kind of a couple of very large LSTs that take up like the majority of the market share. The biggest obviously being Lido's ETH, which is the 8th biggest crypto token overall, which is kind of a remarkable fact. Is your goal for that not to happen on Solana?
Yeah, I think. I mean, of course.
Sorry, let me put it differently. Is that bad? Is that like bad in your view? Because I know people differ on whether Lido's dominance is actually a problem.
I think it is bad. Like, to be clear, I don't follow them super closely, but I think it feels to me like that it almost becomes like the protocol, like Ethereum kind of becomes co-opted by Lido in a way, whereas like the LDO governance holders are the ones that are dictating Ethereum, like rather than the ETH holders. So I would say that's kind of like like a more sort of philosophical argument, but also I think in general kind of like competition is good, right? And so when you have like 100 LSTs as opposed to one, right, then all of these LSTs have to compete. They have to sing for their supper. They have to give sort of users additional yields, additional utility, right, what have you. They have to be creative, and I think that overall is better for the consumers.
Okay, and so like, is there to you an optimal? Because Solana now has like thousands, I think, of LSTs, largely due to Sanctum, which created an LST for every validator. So like, is there an optimal number in the long run of LSTs that there should be? Like, I don't know.
Right.
Let's push this further.
There is I think for the Solana Foundation, right? They also have this kind of often they have this question, which is that what's the optimal number of validators for the network, right? Because and they're trade-off between like, if you have like too many validators, then you kind of like the performance maybe degrades, but at the same time you don't want a tiny validator set because you want it to be geographically and and like legislatively sort of like decentralized, right? So there's always this kind of trade-off, right? For Solana. But for liquid staking tokens, because they're only wrappers around like stake accounts at the end of the day, right? That really there could be a we really mean it when we say infinite, right? And so there really is no kind of like marginal like the margin. So so it used to be the case that when you created a new liquid staking token, your fixed cost was very high. You had to bootstrap the AMMs, you had to bootstrap liquidity with like millions of dollars in incentives, right? And that really is the mode, right? The liquidity mode that kind of like liquid staking competitors on Ethereum have to kind of overcome, right? And so like Sanctum is kind of like democratizing that, and therefore the marginal cost to create and maintain an LST is something like maybe like $10, like $100, right? And we can do it for you, right? Like this, because we've launched so many that you just need to give me your icon, right, and your metadata, and we're off to the races, basically. And so there would be some argument to it if I suppose it was like being bad to the like damaging or bringing down the network somehow, but it isn't, right? So there's no issue, and even if that's all like fragmented, right, the fact is that the liquidity is all unified, so like you kind of get the best of both worlds in a way, right? Now, to be clear, I think like there are some projects that are going to have distribution advantages, right? Like if you launch your own LST today, right, it's probably not going to compete with the likes of like Jupiter LST, for example, right? And so like you do see these kind of like long tail kind of things, but that's okay, right? Because the marginal cost is low, and then the maintenance cost is also low. I think we can have as many as we want. Yeah.
Incubated by Polygon and GSR, Katana is something different, a purpose-built DeFi chain that's focused on giving the best experience possible. It does this by sustainably generating deep liquidity and sustainable, real yield. Katana is built from the ground up, with DeFi mechanics to keep your bags from just sitting idle. All you need to do is use your favorite protocol, and Katana mechanisms do the rest of the work for you. Katana is launching with a notable ecosystem of primitives, assets, and partners including Morpho, Sushi, Lombard, Chainlink, and Yearn. Katana is a DeFi-first chain, built for deep liquidity and real yield, by redirecting chain revenue back to active DeFi users. The 1 billion CAT campaign is live. Bridge and deposit directly into vaults in one simple click, and start earning immediately on your ETH, BTC, USD, and more. Thank you to Eigenlayer for making this episode possible. Corporate and protocol treasuries face a major challenge today. Cash and traditional instruments are losing ground to inflation. ETH, SOL, and other proof-of-stake digital assets offer a unique solution. Exposure to the asset's performance, along with access to long-term, sustainable staking rewards that are uncorrelated to traditional interest rates. Using institutional-grade liquid staking tokens unlocks access to capital efficiency for advanced management strategies, while restaking provides the opportunity to participate in the core infrastructure powering the verifiable cloud. For CFOs, DATs, and corporate treasurers, the path to integrating liquid staking and restaking should be risk-managed and aligned with long-term strategic goals. The Productive Treasury Report outlines practical adoption and a forward-looking vision for the role of the modern treasury as a strategic enabler of new technology. Thanks again to Eigenlayer for sponsoring this episode. As always, investments in blockchain technology involve risk. Terms and conditions apply. Do your own research. And speaking of distribution, I know, like, so the largest kind of LST that Sanctum powers is BN SOL, right? Which is now which is the Binance liquid staking token, which is now the second largest LST on Solana, I believe, which was kind of remarkable to see. I remember when it launched and quickly kind of gained adoption, but it's now the second biggest behind Jito Sol, and it's powered by Sanctum, I guess, under the hood.
Yeah. So it's not, they don't have like so to be entirely clear, like we don't have like we don't have a revenue share agreement with them, right? But nonetheless, the Sanctum liquidity layer does support it.
So what's the economic benefit to offer BN SOL if there's no rev share?
We still take when people are unstaking and they go through our liquidity layer, we still clip the fees, trading fees and things like that. So we do support it, but not completely. Yeah.
Gotcha. There's a Delphi Digital report on Sanctum that came out recently-ish, where they compare Sanctum to the clearinghouse for staked SOL. I guess in the same way that, in a market, if you're a buyer, you don't have to match yourself with a seller. If you're a validator, you don't have to worry about or bootstrapping liquidity for your LST and all these things. So how does that analogy strike you? Is that kind of an accurate way to think of Sanctum?
Yeah, I quite like it. I do like that. I mean, it does make sense. My goal founder is always to kind of grow Sanctum past its core business, and that's why Sanctum V2 and verticals. But I think yes, I think the core business, like the clearinghouse for stake SOL, that's part of it. But really, it's about bringing new people into the ecosystem as well, right? So I think one of the sort of underappreciated insights is that we have, it used to be very DeFi, very Solana native teams that were setting up LSTs, right? And now we're kind of seeing, people like MoonPay, for example, which is like DeFi, obviously like a DeFi team, right? Or like a crypto team, but not necessarily a Solana native team, if that makes sense, right? And then you're getting like centralized exchanges. Again, these guys are pretty agnostic, and I think what is interesting is that because Sanctum is democratizing this, right? You're getting people that I think would normally not have thought about, creating LSTs or creating, even coming into Solana in the first place. Now they're like, oh, why not, right? If the marginal cost is low and Sanctum does all the work, right? Why not? We can do this, and we can leverage our distribution, and people want to be on Solana because it's a great chain, right? It's got great momentum, etc. So I think a lot of it actually is that we're seeing a lot of these new organizations want to start dipping their toes into Solana, and I think the counterfactual is that they otherwise wouldn't have, and I think that's kind of like the net benefit that we're bringing to the Solana system over and above just being the clearinghouse for existing stake SOL, which is I think also cool, but we're also bringing I think net new guys, so I think that's cool.
Yeah. The final piece I wanted to touch on just before we move on to Sanctum V2 and some interesting things you're doing there is that, as you said earlier, kind of the core Sanctum thesis is that there should be like infinite LSTs on Solana, and this unlocks liquidity, and you can go take that staked SOL and use it in DeFi, and there's a real benefit to the network of more LSTs existing. I guess the thing I wanted to ask you about is like, has that been borne out over time? So I have the Blockworks Research Solana dashboard pulled up here. Mid 2024, we were at about 3% liquid staked, 60% native staked, and 36% of Solana staked. So that the headline number, a little under 4% of Solana is liquid staked. Now, September 2025, we're up to 9% liquid staked. So that is larger, sure, but it's still under 10% of all Solana is now liquid staked, and the large majority is still native staked. So for whatever reason or another, users, I guess, are not favoring liquid staking tokens. And so has the Sanctum thesis been somewhat refuted in that sense? Or I don't know. What do you make of the fact that there's not, or maybe I'm being too hard on, Solana. Yeah. Like it has in fact increased, but just what do you think of that data point?
There's multiple ways you could read it, right? Like, first of all, I will say like the liquid staking percentage on Solana, just monotonically increases pretty much, right? It goes up and to the right, and like that's good, right? But also I think like the fact that it's like only 9.22% is like that also feels bullish, right, for everyone who's in the liquid staking space, because it's like, look at the the size of the market. We can take either the gray part, right, which is the kind of like non-stake, or we can take all the liquid stake part. I mean, even the non-stake part is pretty interesting, right? Like now we're seeing, of course, like the institutions come in, right, with the DATs, right, and these guys are you're gonna want to stake it, right? The ETFs are gonna want to stake it, right, and a lot of these guys are, as we continue to build out liquid staking and make it more mature and make it more lindy, right, I think it will become a no-brainer for them to move to liquid stake. And I think like Anatoly has gone on the record multiple times. Maybe I can send them to you in a bit. But he always, like, every time we post something about Sanctum, he goes like, "Oh, like I think that all souls should be liquid stake." So like I think I think he's like probably even more bullish than liquid staking than I am. But yeah, I mean I think like it's clear that as long as we build like we continue to make liquid staking robust, right? That I think that adoption like will continue to increase. And I think the fact that it's 9% means that it has a lot of room to grow. And I think these things move slowly, because it's like I think 2-3 years ago it was like less than 2%, and now it's 9%. And like, maybe that doesn't look like very much, but it's a 4x, right? And that's enough to sustain, like, I mean, across the protocols, like Jito, Marinade, Sanctum, etc., right? You have, I think, almost like $10 billion in TVL. And then just think about if that 10x's, right? Like, and everyone wins basically. So I think it's a very exciting space to be in.
Do you think there's any like reason to native stake? Like when you look at
Yeah,
that 60%, are you like, man, what are we doing? Or is it okay that there's 60% native staked?
so first of all, if you are locked, your SOL is locked, you can't liquid stake. That's like a technical restriction, right? You can only stake, you cannot native stake. I guess the other one is that like the if you just okay, so I think one of the overblown risks is like smart contract risks, right? Like program risk. I mean, non-zero, I want to be clear, right? But like the liquid staking contract is pretty battle tested at this point, right? It's like it's been live for 4.5 years or something like this, right? It secures like over $10 billion in Solana, probably more, right? And so like, I'm not saying that it's not, it's foolproof, but it's really, really kind of like battle tested with a lot of money in it for a long time. So it's like, it's okay, right? So that's, I think that's a little bit overblown, but nonetheless, like I can understand if some people really are very conservative with their risk profile, right? So that's, I think, one of the reasons. But I think that concern is largely pretty overblown. And then another reason is if you are not, I guess, if you're simply not interested in having your SOL be liquid, right? Because if you're like, hey, like I am not interested in rehypothecating, I'm not interested in using it in DeFi, like all I want to do is stake. Well, then liquid staking is not for you, because then like native staking fulfills all your purposes, really, right? And then and if and when I need to exit my position, I'm happy to wait an epoch, right? I'll wait the 2 or 3 days and I'll get the SOL back. It's fine, right? If that really describes your kind of like use case, then I think native staking is fine. Another risk like people always talk about is like depegging, right? Which is they're worried about like liquid staking tokens coming below par, right? And I think this is also a little bit overblown, because the thing is that you can always redeem it for native staking. So at worst, it's just as illiquid or liquid as native staking, right? You can pull it out and you can get the native staking token, right? So yeah, so I think in general, I can think of like, if you are someone who's like even a little bit sophisticated, you want to do a little bit of rehypothecating, you want to, or like just for retail, for example, like ease of, the stake account native UX is not super great. And so like, if you have a token, right, like everyone knows like how to deal with a token. It's an interface that we all understand like very, very well. Yeah, but if you have like very, very low risk tolerance, and or if you have no desire to do anything with your SOL apart from stake it, then yeah, you don't need liquid staking.
I also do just wonder if there's kind of an information asymmetry where if you look at Jito SOL, it costs, $270, but Solana is only 217. And
Yeah.
you don't get this when you hold a liquid staking token, you don't get this nice thing in your Phantom wallet that like shows the rewards compounding over time. So there might just be kind of like a psychological effect too, where liquid staking tokens don't feel like they're as lucrative, even though they're the exact same thing or maybe better than native staking.
You're earning every epoch, and I think we are working on that. So we're building. I don't know if I can share this, but we're building like a portfolio page, right? And so you'll be able to see kind of like your earnings accrue in real time. And I think we're pretty excited about that page. Like the Sanctum website went through a whole revamp. It's awesome. You should go check it out. App.sanctum.so. And then like we're gonna build these new features, so you're gonna be the home of like Solana staking. And I think that's gonna be pretty cool.
Good alpha. Speaking of things that Sanctum is doing, I wanted to get a little bit into what you're calling Sanctum V2, which I guess refers to this new Solana transaction infrastructure vertical you're building out. So a couple of months ago, or was it a couple months ago? Some time ago at this point, it was disclosed in Blockworks exclusively, not to toot our own horn, that Sanctum had acquired Ironforge in an all-cash deal. Ironforge is a transaction infrastructure startup on Solana and some other places, I guess. But you acquired them with the intent to build out transaction landing infrastructure for Solana, which I thought was a really interesting thing and sort of new business line for Sanctum. So walk me through what the thinking was behind wanting to acquire Ironforge and start doing transaction landing, and kind of what are the plans going forward?
Yeah, so the idea for it was like two different kinds of I think Sanctum. Okay, so when I had this kind of like liquid staking insight, right, and this kind of like high level of like, okay, well, stake accounts look like this, so shouldn't liquid staking look like this? It was really kind of like a top-down view of like my thesis of how like staking on Solana should work, or liquid staking on Solana should work. And then I was like building sort of like like one-dimensionally through that vision. So it was really kind of like a top-down approach. But whereas this kind of like transaction lending thing was really more of a bottom-up approach, where when we were setting up LSTs for DeFi protocols like Jupiter and Drift, for example, one of the first questions that we asked them is like, okay, so why actually are you setting up this LST? Right? What are your goals? Right? To understand our customers better, not to look like give horse in the mouth or whatever, but like just trying to understand, right? And a lot of them talk about like, well, we care about lending transactions, right? So for obvious reasons, these are like big Solana protocols. They learn, and with like stake weighted QoS and things like that, right? You want to control SOL so that you can land transactions. And so, right, then this kind of like put the seed in our head, which is like, okay, well, if we're helping these guys, create LSTs to attract SOL to land transactions, maybe we can skip the first two steps, right, and then help them land transactions. So that kind of like was the initial like a thought behind like why we want to do this. And yeah, I mean, I think it shows up again and again, right? Which is that, hey, like with it, like the chain does get congested sometimes, and then things don't work out, right? And so like this is like actually super important, right? Like everything that needs to run on Solana needs to land transaction, obviously. And so I think like if Solana is going to be like, if Solana is going to be like the future of finance, right? If Solana is going to be like the chain, right, the general purpose blockchain for everything under the sun, if it's going to be like the Nasdaq, right, then I think like landing like being able to process and land a good number of transactions is kind of like table stakes, right? And so that's kind of like, that was the idea. And so but when we started like Sanctum, like we have expertise in DeFi, where we have like a trust that we've built with these business teams. But to be frank, we didn't know very much about sort of lending transactions apart from like the because we also run land transactions on Solana, where Solana protocol apart from that basics. And so like we kind of like looked at like a bunch of teams that looked like they were doing good work, right? And then like the Ironforge team kind of like stood out. Sorry. They have this like infrastructure project that at one point was 1/3 of the transaction volume of all of Solana was going through Ironforge in one way or another, right? And then we looked at the product, we did use the product, right? And so every team sort of spoke very highly of the product quality, and so we decided that we wanted to bring this expertise in so that we could accelerate the development of Gateway, which is our service. And yeah, so that's kind of how it had started. And then I can talk a little bit about Gateway. Right now, it is you can think of it as a transaction delivery aggregator on Solana. You have all of these different transaction lending services, right? There's Jito, there's BloxRoute, there's Helios, etc. Right? There's the RPCs and all of this. And I think a lot like this, there's a lot of like confusion, right? And so what we are doing is that the one-stop shop, right? If you use Gateway, you can plug in all of these delivery methods, and it will help you like optimize, observe, right, and figure out which ones of these are actually doing the best. And that's kind of like the core value proposition of Gateway. The thesis really is that if you're a developer on Solana, you shouldn't really have to faff around with like 10 different delivery methods and see which one's the best. You should just use Gateway, and then we'll help you find out and use the best.
Will all of these infrastructure pieces want to integrate with you? Because like, what if I'm Nozomi and I'm like, well, screw Sanctum, I want to own the user flow. Like, I'm just not gonna integrate and like allow some of my flow to be routed through there.
I suppose that is a possibility. I'm not ruling that out. But I think you could also think like, hey, like if you have the best solution, we are going to route to you, right? I suppose if you think back to 2021, I guess maybe the DEXs weren't that happy that Jupiter was aggregating them and forcing them to compete on price and execution. But I think like everyone should be clear, like that was actually a sea change. Like that was a huge benefit to the user, right? Like I don't know if you were before, like before Jupiter aggregator and after Jupiter aggregator, the experience is completely different, and like the users benefited immensely from that. So I think in the same way, right? Like some people are not gonna like it. They may try to stop us, and we'll try to find a way around it. But I think overall for developers, for application developers, and then downstream of that for users, obviously, I think this is going to be a huge unlock for them. So yeah, I think we're doing good for the ecosystem.
Explain to me like where Jito sits in the stack, because I know that it's just like a super core piece of kind of how transactions land on Solana at this point in time. And so like, is Jito just one of multiple potential routes, or
Yeah.
like when we talk about Nozomi and Paladin and stuff, like are those transactions going through those services and then being included in Jito bundles or going through the Jito block engine anyways?
Right. So we are agnostic as to which one. So really, it's about the developer's choice, and depending on your needs as an application developer, right, different senders may have like may be better or worse fit for you, right? So as I said, like if you want sort of like transactions in order atomically, right, then really you only have one choice, right? But if you care about latency above all else, you have another set of choices, right? But if you're like, well, here's an example. You have an Oracle transaction that doesn't need to be top of block, that doesn't need to be like super like latency sensitive, but it needs to land like every like 3 seconds. Like it needs to run like every 4 slots, something. And you cannot be paying. So some of these senders are charging something like 10 cents per transaction, and it's like if you are running an Oracle transaction that costs 10 cents every 3 seconds, you're gonna bankrupt yourself, right? Like it's not feasible. And so I think the nice thing about Gateway is that we just allow you to choose, right? And so we are very agnostic. You just bring in all the ones that you want, right? All the RPCs, all the senders, right? Jito as you like, and then you tell us which ones you want to use, right? And then we'll route it, we'll fan it out, right? We'll optimize it for you, and we'll give you the benchmarks that so you know, like, is this working, right? Is this working as I expected to? Is it performing? How is it performing? And then you can make the decision. So again, I think it's like complementary, right? We are very agnostic as to which ones we want to support, like all of them ideally, and then let the developer have the best experience.
Will there be like a user-facing UI as well, where you could, if you're like a meme coin trader, you could go to Gateway and try to land a transaction really fast that way?
I haven't thought about that. I guess it would depend on whether or not we can integrate them with the front ends that these guys use to trade their coins. So I think at the end of the day, it would have to be on the application level that they integrate us rather than on the user. But maybe there is some clever solution. But I'll think about it. Yeah.
Well, because I'm just thinking about like a Sanctum trading bot. Like that's right. A lot of people like these Telegram trading bots, and my stereotype maybe of those are that they're not the most like sophisticated teams building them necessarily, but they have tons and tons of users, especially at like the peak of the meme coin boom, like Trojan and Photon and so forth were like generating real revenue. And I always thought they were interesting acquisition targets in Solana, which never actually bore out. But I feel like that's almost an easy or like low-hanging fruit for this kind of thing.
You think Sanctum should build a trading bot?
Not financial advice. I'm just an idiot journalist. But it makes sense on first blush to me. Yeah.
Yeah, I am very much not a trader, so I don't know how I could build like a compelling product, but we have thought about it actually. Yeah.
Incubated by Polygon and GSR, Katana is something different. A purpose-built DeFi chain that's focused on giving the best experience possible. It does this by sustainably generating deep liquidity and sustainable real yield. Katana is built from the ground up, with DeFi mechanics to keep your bags from just sitting idle. All you need to do is use your favorite protocol, and Katana mechanisms do the rest of the work for you. Katana is launching with a notable ecosystem of primitives, assets, and partners including Morpho, Sushi, Lombard, Chainlink, and Yearn. Katana is a DeFi-first chain, built for deep liquidity and real yield, by redirecting chain revenue back to active DeFi users. The 1 billion CAT campaign is live. Bridge and deposit directly into vaults in one simple click, and start earning immediately on your ETH, BTC, USD, and more. Thank you to Eigenlayer for making this episode possible. Corporate and protocol treasuries face a major challenge today. Cash and traditional instruments are losing ground to inflation. ETH, SOL, and other proof-of-stake digital assets offer a unique solution. Exposure to the asset's performance, along with access to long-term, sustainable staking rewards that are uncorrelated to traditional interest rates. Using institutional-grade liquid staking tokens unlocks access to capital efficiency for advanced management strategies, while restaking provides the opportunity to participate in the core infrastructure powering the verifiable cloud. For CFOs, DATs, and corporate treasurers, the path to integrating liquid staking and restaking should be risk-managed and aligned with long-term strategic goals. The Productive Treasury Report outlines practical adoption and a forward-looking vision for the role of the modern treasury as a strategic enabler of new technology. Thanks again to Eigenlayer for sponsoring this episode. As always, investments in blockchain technology involve risk. Terms and conditions apply. Do your own research. Give me a couple million FP and I'll build it for you. I'll I'll have ChatGPT make it. Okay, I guess to zoom out, I think one of the interesting things is like the origin story of where this transaction landing infrastructure comes from does make sense. You're talking to Jupiter and Binance or all these people you kind of work with on the liquid staking side, and they're like, we need to get transactions to land on Solana. It's really hard, but it's still, when this news came out, it struck me as like a little not what you'd expect from Sanctum, which so far has been very narrowly focused on LSTs. So is this marking the beginning of like a new way that we would think about Sanctum, as it's not just liquid staking, it's like general Solana infrastructure? Or maybe a different way to put it is like, how much will gateway be prioritized versus the existing LSTs part of the business?
Yeah, so to answer your first question, does this sort of mark like a change in how Sanctum should be perceived? I hope so. And this is kind of like what like Sanctum V2 and Horizons, like all this messaging was about, to kind of like tell the story to folks that Sanctum is kind of like changing from, as you say, right, narrowly focused on liquid staking infrastructure to now kind of like perhaps like more broader like infrastructure more generally. Right. And I think bringing the brand recognition that we have, the trust and reliability, like people entrust us to hold like over like almost $3 billion in Solana. And like we don't take that very lightly. We're very grateful for it. And perhaps we can take some of that the trust that people have and then expand into a new vertical, because lending transactions is also quite a trust thing. You kind of have to trust the provider to be reliable, that they won't do anything funny to your transactions, like sell your flow, things like and so I think there is some carryover there. And so to your point about how should we think about prioritizing these things. So the liquid staking business isn't going anywhere, like, and I wouldn't like it's very much still sort of like foot all the way on the gas, because like it's growing, right? It's only 9%, right? Like, you have all of these amazing catalysts, right? With the DATs and ETS, right? And it's like it's a great time to be kind of like in liquid staking right now, like, to really honestly. And so we are very excited about that. And so like we're consolidating a little bit that LST business, right? Which is that really dialing down how do you sell, right? Because in the past we were kind of like all over the place, and now we're really like trying to dial down how we sell that product. But again, right, very much still full steam ahead with that product. And then we are trying to nurture this gateway. I'll be fully honest, it's a bet, it's an experiment, right? Just like when I started Sanctum with this whole like infinity LSTs thing, like we didn't know if it was going to work for sure, right? I mean, I hoped, but yeah. And so the gateway is likewise a bet, right? It's really a bet on like the proliferation of transaction lending infrastructure, the influx of new developers, right, and all this kind of stuff, right? And so it's a bet that we are kind of like actively nurturing, right? But I think if all else fails, there's always that profitable and growing business that we have on liquid staking, and we can always fall back to that. Yeah. So that's how I would honestly think about it.
So let's make this a little more concrete. I mentioned before, Sanctum notably like does actually make money. So, but like, what are the real revenue drivers to your business today? Like, what is the best or most lucrative business line of all the kind of various LST linked things that Sanctum offers?
Yep. So the primary one is we offer this white label staking service, right? Liquid staking service in particular, right? Which is that you as a partner, right? If you're Jupiter, Bybit, whatever, right? You set up an LST with us, right? And then we do it all for you. It's a white glove service. We're very good at that. Delegate to whatever validators you want, whatever. And in return, we charge like an AUM fee, right? And we split that 50-50 with our partners, right? And that's kind of like the lion's share of the revenues. Of course, this like we we have to earn our keep. So some of that revenue goes into maintaining the unified liquidity layer, right? And we have this product, we have a suite of products. We have the router, we have the reserve, right? We also have Infinity, right? Which is it's basically like it's a clearing house, right? But it's also simultaneously like a SOL yielding strategy, and it's a very, very high yielding, I think the best yielding SOL strategy on Solana that you can get without leverage, right? Okay, with leverage you can get way more, but it has no leverage. And the way it works is that it holds like a basket of LSTs, our partner LSTs, right? And it also allows swaps between them. So at minimum, it's earning staking yields, but it also earns all of the interchange fees between all of the LSTs when people swap from one to another. And so we've seen this like consistently outperform, like the incumbents, for example, like Marinate Sol and Jito Sol. We beat them by like, I think like 100 bips or like 150 bips over the past 12 months, right? Consistently, which is pretty huge if you think about it, because like the base yield is what, 750, 700 bips, 7%, right? And then to get 8.5% or 9% on that is like a huge difference. Not to toot our own horn too much, but so that's a good strategy. But of course, it's a new program. I want to be clear, right? Well, not that new. It's 1.5 years live, but it does introduce like another layer on risk on top. But nonetheless, if you're comfortable with that, I think it's a great solution. And this simultaneously, so this also helps our LSTs, because again, right, it allows that interchange of LSTs. So that is the main kind of like revenue driver that we are. Now we are also like slightly expanding. For that, we also offer validator as a service, right, which is kind of like one level down, right? So if you want like the full stack staking solution, you want to control the validator, you want to control the liquid staking, right, we can provide all of that. Yeah, and then like we have plans to monetize Infinity on its own in the future as well. Yeah.
Yeah. So obviously, we mentioned earlier you offer a few exchange LSTs, especially kind of in Asia-based exchanges. So obviously, Binance is the most successful example of this, where it's actually grown to become the second largest Solana LST. But something that strikes me about that strategy is it's like, okay, there's only so many exchanges. You can't continue to launch new LSTs for new exchanges. And the supply on those exchanges may rise over time. But as far as things that are new, we do have this trend of DATs right now, where one interesting piece of news from Sanctum's perspective is that DeFi Dev Corp, which is one of the Solana digital asset treasuries, launched a Sanctum LST. And I'm assuming that as these DATs, I think I should say a lot of these Solana DATs, either behind the scenes or publicly, are talking about getting more involved in DeFi and like how can we actually generate more and more yield on this Solana that we're holding. And so is that kind of an opportunity you're looking at, as well as offering LSTs for these DATs that are just buying hundreds of millions of dollars of SOL?
Yeah. So that's like, I think that's like a huge kind of like new like vertical. I mean, not vertical, but like a new new use of LSTs that we are like currently actively kind of like exploring. So we're very, very happy and glad to have DFDV as our partners. So we really appreciate those guys, and those guys are really good. And so these DFDVs, I mean, a lot of them are just like optimizing for yield, right? So and then, like as I said, like liquid staking is like a no-brainer for them, right? Because if you're just gonna native stake, like, okay, of course you're not gonna you're gonna underperform, right? Because with liquid staking you can rehypothecate, you can do different stuff, right? Like it's so much better actually, right? So I think it will be a no-brainer, right, for these DATs and ETFs, right, to have their own liquid staking token. And the advantage of issuing your own liquid staking token, right, as opposed to using somebody else's, right, is that you actually have like full control of the validator set, right? So if you, for example, you want, like, I want to delegate to this validator in this, like for whatever reason, right? Maybe you have a deal with them, whatever, right? You can do that. Like we have custom delegation strategy. I want to do 20% here, 20% here, 40% here, right? We can do that. If you say I have to be in a particular domicile, we can do that. I want to have strict deposit guards and maybe withdrawal guards as well, right? Like I want it permissioned, we can do that, right? So like the design space. Oh, if I want to have my own reserve, right? So I want like 80% of it to be staked and 20% to be unstaked, for example, we can do that, right? And that sort of flexibility, that sort of white glove service is something that I think is very unique, right? That nobody else offers. And again, you can mix and match, you can pick what you want, and then we can build that LST that is perfect for you.
That's all we're going to talk about with DATs, because candidly, I'm tired of talking about them on this podcast. So that's it. That's our DAT talk for today. Something random I wanted to ask you about, FP, is MetaDAO. Sanctum became one of the first teams to actually, I guess, formally launch a Futarchic governance model with MetaDAO, which is this sort of new way of thinking about DAOs that's big on Solana, where instead of the kind of classic one token, one vote model, you actually, I guess, trade and let the market decide what a protocol should and shouldn't do as a DAO. So I just want to ask, I guess, how that's been going. I remembered when you launched, but I'm not big on the DAO.
Are you a you're not can I say that on the podcast?
Wait, what did you say?
Futard. Futard.
I'm not. I've never traded in the Futarchy markets, but I'm just honestly curious how it's going, because I think it's a really cool experiment.
Yeah, I mean, so like we get like a lot of turnout, right? So I think we are I know we are like kind of like the largest Futarchy, like by number of like unique wallets, right? I mean, of course that doesn't map necessarily 1-to-1, right? But like for like we are like an order of magnitude larger than the second largest Futarchy, which I think is MetaDAO, right? So we are bigger than them in terms of like number of voters, which is great. We have a great, very active community and voters. I think it's been a very, very interesting experiment, and I think the market has so one of the things is that we really try to put up like real meaty proposals, right? Not just kind of like rubber stamp things, right? So one of the big ones that I really wanted to pass but didn't pass was like, should Sanctum build a mobile app, right? And so I was like super bullish. I was like really excited to build a mobile app for Sanctum, and then like we put it up to vote, and then Marco was like, nope, we think it's a shit idea. And I was a little bit deflated, but I think all's well that ends well. I think like that I took that as a signal to kind of like just like focus on our core business. And I think like in hindsight that I think it was the right call. Yeah. Which doesn't mean we won't build a mobile app in the future, but of course, I mean it's very counterintuitive. It's very hard to explain, although we try to make it fun, try to make it accessible. We did a lot of videos with Profit and Colin about it. But yeah, it's really not easy to get. So I guess that would be the feedback. Like really cool, very interesting, very fun. Probably actually like theoretically and practically like better for incentive design reasons, but like a bitch to explain, like very, very hard. And just like the skill floor is quite high.
Okay, yeah, that's really interesting. It's sort of the Futarchic model at work, I guess you could say. So for those who are not as familiar, basically, the way Futarchy works is the members of the DAO vote based on which outcome they think will be best for the token, which I guess in Sanctum's case is cloud. So it's like, if we build this Sanctum mobile app, do I think the cloud is going to go up or go down? And so this, I guess, holds you accountable to the market rather than whatever the founder wants to do. So,
yep.
You can kind of see this market. The approval market was better than the rejection market for a little bit of time, and then I guess as time goes by, the market starts to decide that actually we think it's going to be worse.
Yeah.
Although looking at it now, the approval market is now trading higher than the rejection market. So very close.
But right. So you look at really the area under the curve. Right. And so
that's what you need to see. Okay.
It's not just that instantaneous thing, it's to prevent manipulation. Yeah. So it turned out that it was initially, as you said, people were really bullish, right? And then it kind of like went all the way down, and it didn't pass in the end. Which was disappointing for me personally. But because I really wanted to build a mobile app. But I think that's cool. I think this is really cool. I think this is an example of like the founder really did one thing, and the DAO, and then not the DAO, but like the community as well as the traders, right, was like, nah, we don't think this is a good idea. And I think that is very cool.
Yeah, well, because that
so much rubber stamp, right? Let's be real, right? So anyway, sorry,
that's what I was gonna say. Is that's the classic tweet about DAO governance. It's like, founder, which color Lambo should I get? 90% yellow, 10% red. Then the founder votes, and it's 60% red, 40% yellow. So it's kind of like, for a lot of these projects historically, it is governance theater, and
Exactly.
the founder can kind of do whatever the founder wants. So it's cool to see, like, yeah, the Sanctum token holders thought that it was not a good use of time to build a mobile app, and so they didn't. I think a Sanctum mobile app would have been cool, but I'm
Me too.
not voting in these things. So
Yeah.
is that like a potential future thing that you'll still explore, or like, and also I guess what would be, would this just be for like Sanctum LSTs basically to trade between them? If you were
Who
to
knows?
do it in theory. Okay.
I think I see a future where Sanctum just expands, like not just for infrastructure, but really tries to, like, one of the things that Sanctum does very well is we have an amazing brand, right? And we have an amazing brand, an amazing community, like superlative community. We managed to gather like the earners, right? We managed to get like the people who really are in the space for the love of the space. And I think I really want to build like a consumer app for them. But maybe like the lesson here is that we've got to lock in and focus on our existing, like B2B infrastructure business right now, make like $100 million, and then we can make the consumer app play. So that's like the lesson that I'm taking away from it, which is like, we probably will do it at some point, but not right now. Yeah.
Mm-hmm. I also just wanted to get like a broader take from you on tokens, because as we're talking about with MetaDAO, the project is kind of accountable to the token holders for what decisions they make that are subject to governance, which is different from how things used to work. We also are now seeing this like revenue meta where the hyperliquids and the pump funds of the world are, taking their profit, I guess, and buying back the token, or even just taking their revenue, not their profit.
And distributing it. Yeah.
Yeah. Do you think that's going to become just like table stakes where every project begins doing some version of that?
Yeah. So really, this is a like an incentive alignment problem, right? And so what are the problems is that for many cases, first of all, projects may not make revenue. It's all bullshit, right? And as you know, like as you correctly point out, Sanctum is one of the few projects that is making revenue and profitable. But yeah, like the fact that, I think that should be table stakes, right? You should build profitable protocols. Yeah, and then if you want to think about it, like if you think about putting all your revenues and putting it to the token, I'm not sure that's a good idea, right? Because first of all, right, like some of you, if you put all your revenue into the token, I think that can be quite reflexive, right? And then where's your where is your runway for like when things go south, right? Or like, do you not want to have like a war chest or things like that? So, and like, is the best use of the protocol revenues like simply to pump the token, or should the protocol keep some of it back and reinvest in R&D and growth and try to go to the next level? So there are all these kind of like very good reasons why like protocols shouldn't just full send it into the token. I think that's very valid. But I think what I will say is like there's a really demand for this because it's an alignment problem, right? You fundamentally, right, like token holders do not have the same sort of like rights and as equity holders do, and that's the problem, because like if I buy a token, I kind of have to pray and kind of hope that the founders eventually kind of return value to the token somehow, right? And buybacks are like a very kind of like aligned way to do it, right? It's like, hey, they go token go up, right? We're all gonna be rich together. Like that is like a very clear incentive alignment. And so, but I think it's like the least bad. Like like people always say like democracy is like the least bad system that actually works. I think it's like similar, right? Because this incentive alignment problem is a very, very difficult one, right? There's a lot of governance problems, etc. Right? Founder can always run. So I think that's what buybacks is solving. But I think it's the least worst problem. Like it's the least bad solution rather than like a good solution, to be frank with you.
Yeah, that is a, kind of a good way to put it, I would say. What about Fire Dancer? We're seeing something interesting as I'm digging into the liquid staking and staking world a little bit more. Is we're seeing the growing adoption of Frankendancer, I guess it is, which is the half and half version of Fire Dancer that's come out. It's up to I believe 18% of stake is now running it. At 20%, that's kind of a big milestone of like, okay, the network actually depends on Frankendancer for liveness in some sense. Does that have implications for liquid staking or any of the business lines that Sanctum runs? Like, what's been your perspective on that?
So not directly. I think the bigger one is more of like changes to the consensus algorithm and changes. I mean, like Alpenglow, right? Changes to how the staking thing work. But I mean, I would just give like a quick comment, which I think like client diversity is very very good. And like it for all the terms and purposes, I think like both teams are like super locked in. And if that makes like Solana faster, that means validators print more, and that means got like more staking yields for LST holders. So I'm very glad that I don't know if you know, like block times are getting faster, like confirmations are getting, it's like the network is getting better, which is like not just like good for Sanctum as a company, but also really, really good for Solana as a whole. So I'm very bullish on that.
Interesting. And maybe say a little more about Alpenglow, because the vote just passed. Alpenglow is officially happening. I think they said they want to roll it out by December.
Yeah.
By breakpoint. So what's your perspective on the consensus rewrite?
I don't have so I'll be fully transparent. I don't have a good and educated take on the consensus changes just yet. But I mean I've briefly skimmed it, the white paper. So I don't want to profess that I know things. But like one of the things I will like, I think two main observations. First is that I think like this is one of Solana's strongest qualities, that we're willing to make that we're willing to make breaking changes, right? In the service of making the network better. But it also means that all of us actually cannot like ossify, right? Like if there are constant like upstream changes, right? The stake pool, like changes to consensus means changes to staking means changes to liquid staking. And we have seen, like, even before this massive Alpenglow change, there have been many changes down the line, right, in the past, and we've had to change to adapt. So I think it keeps like the average Solana protocol on their toes. It keeps us on our toes and make sure that we have to continue to innovate. And I also like that as well. So I think it forces all of us building on Solana to just be better, and not be complacent. So I like that.
To close, like, when can we expect to see some of this stuff? Like, when will Sanctum V2 and this transaction landing infrastructure and everything get rolled out in a real way?
So V2 is live, right? The website is live. Everything is live. We have a brand new Sanctum page that puts out all our 4 products that we currently have. We have the staking as a service, validator as a service, Ironforge, and Gateway. We have all these products live. Gateway is live. I think it serves about like 30,000 transactions a day. Don't quote me on this. We've been in private beta, but it is live and it is in production. And so far it's been really good. It's been awesome. And then like Gateway, we have a big change to Gateway. I mean, it was like V0, right? Private beta. We're going to roll it out to V1 very, very soon. And I hope to like everyone is gonna use Gateway. We think that Gateway could be like the de facto kind of like, just like anyone pretty much uses Jupiter, right? We want people to pretty much just come and use Gateway because it'll give you the best of transaction landing experience. So yeah, I'm super excited for all these changes. And yeah, they are really live. So go and play with it.
Heck yeah, very interesting. Excited to see kind of what Gateway does and how that works. It's a really fascinating yarn. FP, we're across the world, so I will let you. I'll let you get to sleep while I have to go about my work day now. But I'm glad we got to make this work. It was really fun getting to speak with you, and best of luck with everything you're building out over at Sanctum.
Thank you. Thank you very much for your time.
Thank you, everyone. If you made it this far into the episode, we would love if you gave this one a like or a 5-star wherever you get your podcasts. If you enjoyed this episode, please share it with a friend, and we will see you all again very soon.